In our last video on credit cards, we decoded the working and basics of credit cards with an expert for better understanding of young earners. We learned about the interest on interest mechanism with simple examples, a crucial concept. Now that you have clarity on the basics, it's time for you to learn about some healthy credit habits and the best practices to adopt. Vishal Dhawan, founder and CEO of Plan Ahead Wealth Advisors, helps us with the same. For young earners or those starting out their financial journey, he highlights three watch-outs or to-dos. Listen carefully.
So I think the biggest thing that young earners need to be careful about is to ensure that they don't assume that their credit limit should be what they should be spending. I think very often young earners tend to use that as the benchmark. And therefore, if they have say a 1.5 lakh rupee credit limit on their card, they tend to, try to get to that. Now, ideally, what you want to do is you don't want to go maybe more than 30% beyond your credit limit. Because if you start overusing your card, you're running two risks. One is that do I have enough capacity to pay back? And number two is that if I borrow too much on my credit card or I spend too much on my credit card, it doesn't reflect very well on my credit scores. And therefore, when I go out in the future and start to take loans, I'm going to end up hitting a bit of a challenge because of my credit score. The second thing that people need to be very careful about is that a lot of the interest rates that get talked about on credit cards when you roll over your debt is typically talked about in percent per month. And when you annualize those numbers, those are very, very large numbers. And therefore, you want to be very careful to always pay out everything and not the minimum amount due. Because what tends to happen is that's a number that comes right at the top of your credit card statement normally and tends to get focus. Last but not the least, keep in mind that in case of certain kinds of transactions, like when you use your credit card to withdraw cash from an ATM, you will find that your interest starts getting charged right away and not from the date on which your normal transactions are due for payment. So there is really no credit cycle on cash when you withdraw it from an ATM. There is a credit cycle only on payments that you do either using your credit card at a merchant or online. So be careful about these three things.
He explains the kind of credit habits to avoid with a simple example that many would relate to.
For example, you want to travel and you had planned to stay in a 3-star or a 4-star hotel. And you're now seeing that there is a 10% off if you book on your credit card because on a 5-star hotel, you could still end up paying much more than what you would have paid otherwise, in spite of the discount. So you need to be very, very aware of that. Ideally, the best thing to do is to use a debit card for luxury spending, because what ends up happening with a debit card is that automatically you can only spend what is in your bank account. And if you can only spend what's in your bank account, then you will cut some other expense to make up for this.
Surely debit cards don't have all these hassles and caveats. So would it be good and make sense to use your credit card like a debit card?
Yes, so I think it's a very good approach to take where you say that, what I will spend on my credit card is going to be driven by the money that I have in my bank account. So I might use the credit card because it might give me certain benefits. It might give me a certain cycle for which, within which I can pay back without any interest cost. Those benefits are there, but those are double-edged swords, because what tends to happen is that you can always end up either missing a credit card payment or you could end up doing overspending.
It turns out there is some behavioral economics and psychology behind this too.
The way our minds work very often is that we tend to use the same money in our bank account for multiple purposes. So let's say if I have a balance lying in my account of 50,000 rupees, I could imagine that I will use this for my regular monthly expense. I will use it for my travel. I will use it in case of an emergency in my family. And unfortunately, the way our mind gets muddled means that the best approach to take is to literally spend out of my bank account.
Do you know which segment of borrowers credit card companies and lenders target? In other words, who faces the most risk of falling prey to credit card debt?
So we think that people who are new credit card users uh, typically tend to be those who are most prone to falling, into a credit trap, and also a lot of people who run into a financial emergency.
Young earners usually fall in this subset of credit card users, that is, new or first time users. The risk is inherent in these two factors.
If you look at how credit cards are issued out, they start getting issued out very soon after you go out of college. And the freedom that it gives you to be able to spend on a lot of things without having to check with anyone, without having to borrow money, etc., is significant, and it's also very convenient because you can just, go into a shop and buy whatever you want, or just go online and buy what you want. So I think that convenience creates the risk, and the credit limit creates the risk.
Newfound freedom, physical or financial, can often make us blinded or short sighted to the long term consequences of a debt trap. When it comes to equities, we all surely enjoy the power of compounding. But when it comes to loans and interests on them, exactly this compounding is what can be very harmful. And speaking of equities, for millennials and young earners, just as important as starting investments and saving is keeping credit and debt in check. That's all from us in this video. Did you hear about ET Wealth's latest offering? Check out our newest section, ET Wealth Legal, your go-to guide on estate and succession planning, wills, heirs, and more. Stay tuned for more financial planning help and stay safe.